So the Sharpe ratio, which is also known as the reward to volatility or variability ratio, is simply defined in terms of the mean and the standard deviation of returns. Right? Specifically, it's equal to the risk premium, the excess return, provided by the portfolio, divided by the standard deviation of the portfolio return, right, by the portfolio volatility. Right? In other words, okay. Now, developed by William Sharpe, the Nobel laureate, the Sharpe ratio has similar premise as the CAPM framework, right? That is, investors seeking to maximize their mean variance preferences, as we saw in previous courses, will want to choose portfolios that maximize the Sharpe ratio, right? That maximize the reward, right, per unit of variability, right? Basically, get the biggest bang for your buck, so to speak. Now, if we replace the ex ante expected value of the excess return with estimated values, right, we basically get the ex post or the historical measure of the risk-adjusted return. And this gives us, right, basically, right, the excess return on the portfolio divided by the portfolio excess return volatility. Okay? Now, recall from portfolio theory and the CAPM framework that in the hypothetical world of the CAPM, right, the maximum Sharpe ratio attainable is in fact that of the market portfolio, right? In other words, investors maximizing utility will hold a combination of the market portfolio and the risk-free asset, and that gives them the highest Sharpe ratio. Now, in the real world, the Sharpe ratio still provides a meaningful basis to rank portfolios, right? What does it tell us? Well, it tells us, holding everything else constant, right, that investors would prefer a portfolio with a greater Sharpe ratio, right, a greater excess return per unit of risk, than one with a lesser Sharpe ratio. Okay, so what does the Sharpe ratio not measure, or what is the Sharpe ratio not used for? Well, the reward to variability ratio defined by the Sharpe ratio is not a good measure to evaluate the performance of individual securities, right? Why? Well, think about it. Because in the denominator you have the portfolio excess return volatility, right, the total volatility, it does not really take into account the correlation between securities and therefore ignores the potential diversification benefits of an individual security. All right, so let's look at an example. All right, so in this table, I have the excess return and volatility for 3 common U.S. equity indices, right, over a period, over a 2-decade period from 1987 through 2006, right? And to facilitate comparison, I have annualized the data, including the Sharpe ratio. Oh, wait, how do you annualize, for example, a monthly Sharpe ratio? So if I wanted to find the annual Sharpe ratio from a monthly Sharpe ratio, a Sharpe ratio computed from monthly data, well, it's like the volatility. I would want to multiply it by the square root of 12, right? So you multiply the Sharpe ratio by the square root of the number of periods in the period. Okay, so going back to the table, we see that the broadest index, Russell 3000, right, relative to S&P 500 and the Russell 2000, right, has the highest Sharpe ratio, right? It's higher than the large cap index represented by the S&P 500 and the smaller cap index, the Russell 2000, which makes sense, right? So because the Russell 3000 is the broadest index of the 3, so the volatility is smaller than the rest of the other 2 indices. Now, one final word of caution. Note that the Sharpe ratio gives us an appropriate measure of risk to the extent that the portfolio represents the investor's entire wealth at risk. Now, why is that? Well, this is because, as I mentioned before, right, Sharpe ratio is not an appropriate measure for measuring incremental risk, right? Where, for example, an investor might be combining a portfolio or an asset with the investor's rest of the portfolio, right? Because the volatility measure is the total volatility. All right, okay, so in this lecture, we started our tour of the risk-adjusted measures of performance with the most common and the most well-known measure, namely the Sharpe ratio, also known as the reward to variability ratio. It is defined simply in terms of the means and the deviations, and it can be used to rank portfolios that represent the entire wealth at risk of an investor.